Welcome to our Taking Stock video for the week ending the 24th of March 2023. I'm Kien Trinh, Head of Research at Stock Doctor, and joining me today is our Senior Portfolio Manager, Matthew Swartz, to stream to you all things share market. Welcome, Matt. Great to have you on board.
Thank you, Kien. It's good to be joining you.
Well, just before we get started, just a reminder that the information provided today is of a generic nature and therefore shouldn't be considered personal advice. Shares are volatile, so any charts and tables presented shouldn't be relied upon as a guide for future performance. Well, Matt, what an eventful week it's been. The turmoil across the global financial system, it appears to have stabilized somewhat after Swiss authorities engineered a buyout of Credit Suisse by global rival UBS. And to stem contagion fears, the European Central Bank, they vowed to support Euro banks with loans if necessary.
Yeah, Kien, what a start to the week it was, really. For us people in the finance industry, this was a very, very big deal. And although many people could argue that the demise of Credit Suisse has been a long time coming, given the number of scandals they've been involved in for over all these years, to see them acquired by the biggest rival in this manner was quite staggering. It sounds as though the transaction was pretty much forced upon both parties, with the Swiss authorities knowing that Credit Suisse were on the brink of failure and did need a solution before markets opened on the Monday. So UBS also seemed a bit of a reluctant buyer, but managed to strike a pretty attractive deal where regulators enforced them to buy the company for about 3 billion in UBS stock. But they also got liquidity assistance of up to 100 billion Swiss francs from the central bank, as well as a loss guarantee on parts of the Credit Suisse portfolio. So a fairly attractive deal, in my opinion, for UBS shareholders. But what caught many people's attention was that the regulator FINMA decided to write down about 17 billion in nominal value of Credit Suisse additional Tier 1 capital. They wrote it down to zero. And many likened these securities to the hybrids that Australian banks issue here in Australia. But upon closer inspection, it would seem that these Tier 1 capital issued by Credit Suisse was actually quite risky, and that regulators were well within their rights to write the debt down to zero. And the bank hybrids securities here in Australia do rank above shareholders. So on that basis, this type of event couldn't happen here in Australia.
Yeah, very interesting, Matt. By writing down the hybrid securities, the Swiss regulator wanted really to boost the capital position of the bank by wiping out its liabilities at the expense of the bondholders. And as you said, Matt, although this is unlikely to happen here in Australia, these events could lead to higher wholesale funding costs worldwide, which could impact Australian banks from their earnings in FY24. So we will be monitoring the risk to their dividends, especially in coming months.
And meanwhile, the US Federal Reserve has approved yet another 0.25 percentage point interest rate rise, but did concede this time around that instability in the banking system in the US may end its rate rise campaign sooner than expected. And the Fed tried to stem investor concerns by suggesting that the problems leading to the Silicon Valley Bank's collapse were not systemic, meaning that the weakness is not inherent across the banking system, but rather only affects a few high-risk banks. And as a result, 17 out of the 18 Fed officials now expect the Fed funds rate to rise at least to 5.1% by the end of the year, implying one more 25 basis point rate rise.
Yeah, another interesting news there. Even though the interest rate rise was in line with expectations, market sentiment remains quite weak, and it's probably partly due to concerns that further rate rises from here may exacerbate the US economic contraction that we're seeing. I mean, the bond market is clearly pricing in a hard landing for the US economy, and it's anticipating that the Fed will cut its rates as soon as mid this year and into 2024. So this is in stark contrast to equity markets at the moment, which appears to be pricing in a soft landing for the global economy.
Yeah, it's all very confusing, isn't it, Kien? So, what does this all mean from a portfolio perspective? And with earnings risks on the horizon, investors should focus on risk management, which means remain diversified and invest in financially healthy businesses with resilient cash flows to ride out what we expect to be a fairly challenging macroeconomic backdrop. Ideally, have some cash on the sidelines to mitigate against portfolio volatility and allow you to take advantage of these opportunities when they present. Currently, our managed funds is holding between 25 and 30% across all of our products.
Yeah, and it's been a relatively quiet week this week concerning our star stocks. However, the global financial turmoil has led to significant volatility across some of our financial stocks, one of which is borderline growth star and star income stock, Credit Corp. Now, the company operates in the debt collection sector and is also involved in unsecured consumer lending. And the company, remember, it stuck to its full-year guidance following its first half results, but the share price has been very weak. What is driving that weak share price sentiment, Matt?
I think the market really can, isn't it? The company is highly leveraged to economic activity, and with global financial stress potentially leading to a weakening credit environment, investors are obviously a bit cautious that the earnings may be impacted. For example, while a slower economic environment could lead to an increase in the supply of bad debt sold by the banks, the opportunity for Credit Corp could be offset by deterioration in credit quality. So it's really a delicate balancing act for the company. But historically, they've got a very good track record of both pricing PDLs well and generating solid profit margins.
Yeah, also, I note that while management did reiterate their full-year guidance, to achieve this, the number implies a 66% second half contribution, which does seem increasingly challenging, especially if economic conditions deteriorate. But we are hoping management will provide a trading update in May, at which point we'll rerun our ruler over this exposure.
And moving on to another borderline star growth stock, the industrial chemicals business, Incitec Pivot. Now, the share price has been impacted by falling commodity prices with the ammonia and fertilizer market, which has led to some earnings revisions. The sale of the Waggaman plant in the US is the first step in the divestment process of Dyno Nobel explosives business, which is likely to return about $800 million to the company. So we're looking for potentially a share buyback or special dividends as a result of that.
Yeah, we're watching this one closely, Matt, because the demerger has been delayed by about 12 months. So a share price de-rating may not occur anytime soon. Also, the fact that the outlook appears quite weak and suggests that the stock could be removed from our coverage even before it next reports in May. Okay, now moving on to our corporate calendar, two of our star stocks, Gold Road Resources and also Premier Investments, they should report their results on the 27th of March, while a few listed property trusts are expected to go ex-dividend at the end of March. So for more information, please refer to Stock Doctor's corporate calendar page. And this week, under the microscope, we're examining star growth stock and star income stock, Macquarie Group. The company is a diversified financials firm with operations spanning investment banking, asset management, retail banking, and commodities trading. And given the recent collapse of Swiss investment bank Credit Suisse and its subsequent merger with UBS, many investors may be wondering whether the financial contagion and falling bond yields could put pressure on the profitability of this business.
It's a good question, isn't it, Ken? But with revenue tied to global markets, Macquarie is obviously not immune from financial contagion. However, there are a lot of moving parts which make it especially difficult to fully understand the overall impact. But with bond yields appearing to have peaked, this could be a net positive for the bank's asset management division because it allows the business to revalue its assets higher. In addition, the outlook for commodities division should remain pretty strong due to the volatility in trading conditions. However, its banking division could be faced with higher funding costs and capital requirements.
Yes, and let's not forget its capital markets division, which could be weighed down by weak market sentiment, leading to less capital raisings and IPOs, for instance. But for now, members can keep an eye on its 3-month earnings revisions under Golden Rule 3, which remains positive. But what is the risk, Matt, of insolvency with Macquarie, given what's occurred worldwide?
So circling back to the factors that brought Credit Suisse to its knees, we believe the risk of insolvency is actually quite low. The issues that plagued US bank Silicon Valley were poor risk management and a lack of regulatory oversight. And in Credit Suisse's case, it was the bank's unfortunate tie-ins with scandals such as Greensill and Bill Wang's Archegos Capital, where losses and subsequent regulatory fines weighed on the bank's profitability.
Yeah, additionally, management at Credit Suisse is akin to really a revolving door, and the lack of proper leadership made it very difficult to steer the company. So these factors are not inherent in Macquarie or the big four banks.
And having said that, the earnings forecast beyond FY23 is for softer performance as commodity prices begin to normalise. This is what's prompting consensus to forecast a 9% decline in EPS over the next financial year. The stock is currently trading at 17% discount to consensus valuation. And although this appears like an opportunity, investor sentiment will continue to be tied to global financial conditions and credit markets.
But the great thing about these volatile conditions, Matt, is that currently Macquarie has more than 10 billion in surplus capital and is prepared to deploy this to take advantage of distress opportunities if financial conditions deteriorate further. So this should benefit the return on equity over the long term and even support its modest dividend yield at around 4.6%. And with bond yields collapsing over the last few weeks, an interesting question for investors is how do bond yields, in other words, interest rate expectations, drive equity market returns? Well, Matt, in theory, falling bond yields tend to improve stock market valuations because equity valuations often use discounted cash flow models, which estimate the present value of a company's future cash flow. So discounting the cash flows at lower interest rates leads to higher equity valuations. In addition, with falling bond yields, the return on bonds becomes less attractive, and that induces more investors towards equities, and that should drive share prices higher.
However, in practice, it's not that simple as we know. Falling bond yields, as is the case right now, suggests that the bond market is pricing in a period of economic contraction for the future. So this is highlighted by the chart on screen here, which shows an inversion of the yield curve. And when long-term rates are below short-term rates, more often than not, an inversion of the yield curve is a precursor to a recession, which is represented in the shaded areas.
Yeah, very interesting chart there, Matt. And historically, there tends to be a positive correlation, isn't there, between equity markets and bond yields when interest rates are low. And here's another interesting chart you can see on screen, which compares the correlation of weekly stock market returns with interest rate movements. And the reason for this positive correlation here is that when there's an economic contraction, that could lead to lower future profits and cash flows. So this is why we're seeing weaker equity markets coinciding with falling bond yields over the last couple of weeks.
Definitely an interesting chart there, Ken. And look, I hope everybody found the information useful today. So please feel free to contact our analysts for any further clarification. Or better yet, come along this Monday to our weekly webinar, Lincoln Live, where myself, Tim Lincoln, Ken and Rob Manfrey will be presenting to answer any questions that you may have.
Yeah, thanks, Matt. Thanks for your contributions today. I know this financial turmoil, it's keeping us up at night and keeping us alert in managing our stocks and our portfolios, isn't it?
It is my pleasure to be with you though, Ken. Thank you.
Now, just to summarize this week's video, the global financial turmoil and also falling bond yields, it's suggesting that a challenging global economic environment is ahead and markets could remain volatile. So it's important to maintain strong risk management processes in place, be diversified, invest in those financially healthy businesses that can ride out this challenging environment. Take care and have a happy, healthy, and prosperous week, everyone.